Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more educational content like this, please visit adisa.org and check out the resource library. My name is Greg Mausz. I'm your host today. I have Warren Thomas. He is the managing partner at ExchangeRight, and we're going to be talking about real estate in these challenging times. So Warren, thank you for joining me.
Thank you, Greg.
So we have rising interest rates. We have inflation that's been rising, and now we're waiting to see the latest numbers. How is all these market dynamics affecting real estate?
Yeah, thanks, Greg. I'm glad to be here, and that's a great question. There are so many things occurring here in the fall of 2022, and although I have been in this industry for quite a few years, we haven't experienced anything quite like this in the past. What we're seeing today is a rise of inflation. We're seeing stagflation as a factor of the inflation rate being over 8% and the wage increases being limited to about 5%. We're also seeing a rising interest rate environment where the 10-year Treasury, for instance, has moved, where we were looking at loans at 3.5% a year ago, and now we're dealing with 6%, 6.5%. Money today. So there's a variety of things that have changed over the last few years, and particularly the last few months.
So what should investors do?
Be careful.
Okay.
Investors need to be careful. They really need to understand what the investment is that they're buying. They need to understand the fundamentals of the investment, how it's going to perform in various environments, and they need to be taking a really defensive view on their investment dollars.
So I'll interpret that as make lots of small bets. I mean, to invest in lots of different asset managers, real estate programs, sectors in order to protect yourself?
Well, I think if you understand, you need to get an understanding of the sectors and the impacts on a particular sector of particularly now we're looking at we're in the middle of we're in the beginning probably of a recession, and we're beginning to see stagflation. Stagflation is being, that's when we have rising inflation, but we have wages that are unable to keep up with that inflation. So we've gone through a time where we've been in the 8% plus on inflation, and we're capping out at about a 5% wage inflation. And so there's that margin is creating stress, and is stressing the consumer's ability both to pay rent, to pay mortgages, to cover the utilities, all those housing costs. And we've been in a very low interest rate environment in the past. And so the consumer that has been carrying debt, for instance, may have had manageable payments in that debt, but now if it's a credit card, they're seeing a significant increase in the cost of their monthly payment on that card. And if they are a homeowner and they were lured to the adjustable rate mortgages, they're seeing adjustable rate mortgages that are tied to what used to be LIBOR, but it's really a federal funds rate. And they're seeing something that would have been a 3.5% just 8 months ago that's now hitting them at 6, 6.5, maybe even going to 7. So that's doubling some of their payments. So in that environment, it's going to affect different asset classes in different ways. For instance, in the multifamily, when we begin to see a stagnant wage growth, but we've got inflation, then the actual operation of that multifamily property, you're going to see that it's going to be more difficult to retain good tenants in the asset. You're going to have increased bad debts, which we've seen big increases in bad debts already. We're seeing more move-outs occurring currently. We're seeing more concessions being offered. And all of that is based upon this affordability, which is largely driven by this stagflation environment. Back to those that actually own real estate, it's kind of interesting because even though we have stagflation, meaning a lot of things are inflating in value other than that wage is not keeping up, we're also seeing in certain sectors a decrease in value. So we're beginning to see the housing market in general decrease in value. and I know a lot of our ADISA participants are in the DST space or they're in the REIT space. And if you're in the DST space, you're counting on that individual investor wanting to do a 1031 exchange.
Right.
And yet across the country, it's still selective, but we're seeing decreases in property values in certain markets. And just to give you an example, if we take the LA market, 25 years ago, the average amount of an LA person's monthly income that went to housing was about 36%. Now it's about 72%.
Wow.
You imagine, Greg, if you had to pay 72% of your income towards your housing costs, and those housing costs could be defined not only as the rent or the monthly mortgage payment, but they're going to include the rising property tax. And when municipalities get in trouble, they raise their property taxes because they're trying to, and then utilities. We haven't even begun to see utility inflation. We've seen commodity inflation on oil and gas, but we haven't really seen a winter yet. So we haven't seen this inflation hit the consumer. And back to 1031 exchanges, when you start to see those high costs come back to properties, you begin to see property values declining. And that's what I think we're heading into over whatever period of time we're in a recessionary environment, a stagflationary environment. We're going to probably see downward pressure on housing. We're already seeing it, but I think it's got a long way to go to the negative.
Well,
Yeah, you're really positive.
It'll be interesting, yeah. But that's okay. So how are you seeing cap rates be impacted by all the things that you just described?
Yeah, so cap rates, usually the individual property owner, the guy who's he and his wife have owned their rental property for 30 years, they don't think cap rates. What they think about is, my property was worth $1 million 5 months ago, and now my realtor's telling me I can only get $800 for it. Well, you're going to think cap rate, I'm going to think cap rate, because that's what we do. But all they're thinking about is $200,000 that they don't have, that they would have had if they sold 8 months ago.
True.
So from their perspective, they are being impacted by cap rates. The cap rate is adjusting, but not in the same way as the commercial property. Now, with what we do with ExchangeRight, we're very heavy in the net lease marketplace. So we deal with necessity retail, necessity medical. And in that cap rate market, I would have been buying at, say, a 5.4 average cap rate if I'm buying Kroger's and Walgreens and Walmarts and all of that. And now I'm seeing above 6 as my base. So we're seeing cap rates go up, which means prices are going down, right? And so, frankly, I like that environment. I like it because I think in the long term, it de-risks our investors by having higher cap rates. It's going to give the investors more margin. But those cap rate adjustments are affecting multifamily. And multifamily is not only getting impacted because of rising cap rates, which are not directly tied to interest rate, but they usually lag it,
right? Yeah.
Right? So they're beginning to see the impact of cap rates going up. They are seeing them go up as interest rates are well ahead of that. And that's going to drive the value down on multifamily. And then if we get into even worse recession, worse stagflation, then it hurts them more because they've got operating expenses. In the necessity retail side, the inflation isn't as bothersome, but it does affect in all of these classes the way that we put debt on a program.
Okay, explain that more.
Yeah, so a year ago, I could get my debt. I'd put together a $100 million net lease portfolio, and I could get my debt at a cost of, say, 3.3% on a 10-year fixed. Okay. Now, the same portfolio, if I was bringing it out today, because of this increase in interest rates, I'm going to end up having to take about a 6% 10-year fixed financing, maybe 6.5%. And so what that does to the investor in the past, I could create positive leverage. Even if I was buying at a 5.5 cap or a 5.4, I'd create positive leverage. Well, now, if I buy at a 6 cap, and by the time I've got my costs of putting the product together, and then I marry it with a 6 or 6.5 interest rate, I'm creating negative leverage, and it's driving cash flows down. So the investors don't like seeing that cash flow drop on new product, but that's the reality that we're now in, and then that's creating a product that we're going to be intentionally having less debt on the product because it's not benefiting us. And
but that's not necessarily a bad thing either.
It's not a bad thing because what we're really doing is de-risking our products for the future, for the current and for the future.
So based upon everything that you see going on right now, where are the good opportunities?
I think it's a good time for us with our particular asset class. It's a good time for us to be buying. Now, we don't know how long cap rates are going to continue to go up, meaning prices going down, but I'm betting more on a deflationary environment coming because I don't think monetary policy can continue to keep these higher interest rates for that long. You know, how long is that long? 6 months, 12 months? But I think now is a good opportunity to be buying. And
all classes of real estate?
I know it is for our class.
Which are what?
Net lease, necessity retail, lease to investment grade companies that will do well in a recession. Where you got to be careful right now is, as we started talking about earlier, was multifamily. You need to be careful because you better be planning, you better be watching your rent growth assumptions. You need to be really careful what markets you're in. You see the markets where people are leaving certain states and going to other states. That migration may continue. Then again, it may not. So far, it's been a healthy migration. But you need to watch out because multifamily is going to have more pressure on it for concessions, bad debts, stagnant rent growth, because if you have stagnant wage growth, you cannot have significant rent growth. So you got to be careful with that. Industrial, probably a safe place to be as long as the credit is good and as long as you're not overpaying. Any asset today, you have to make sure you're not overpaying.
Sure, it makes complete sense. Thank you for this timely conversation. I got a lot out of it, and I hope y'all did as well. So thank you for watching another episode of Focus on Alternatives. And again, visit adisa.org for more information. Thank you.
Thank you.